Welcome to this REG exam tax strategy video, where I teach you 4 crucial topics that are definitely going to show up on your exam. We're going to go into entity taxation and individual taxation. But first, before we jump in, I wanted to give you a bonus tip, which is to make sure that you look through all the major IRS tax forms. This includes Form 1040, all of the schedules for 1040, Form 1120, 1120S, and a partnership Form 1065. Make sure you're familiar with these tax forms to make sure you're understanding how the theory actually applies to the real world. So now let's jump into our first key topic, which is on partnership basis. You want to understand what increases partnership basis and what decreases it, and how to calculate ending basis. The first thing to know is that income increases partnership basis, both taxable income and non-taxable income. Next, you need to know that the partner's share of the partnership's liabilities also increases the basis. Because if the partnership has a liability that it doesn't pay, then the partners are going to be responsible for paying that liability. So it's going to increase their basis in the partnership. So then a payment of the partnership liabilities is a reduction in the partner's basis. And then a loss is a decrease to basis, and a distribution is a decrease to basis as well. So you want to make sure you understand this key formula for what increases and decreases partnership basis.
So now let's consider this practice question for partnership basis. What is Quinn's ending basis in QRS partnership? QRS partnership, where Quinn is a 30% partner, incurred an operational loss of $300,000 in 2024. So Quinn will take 30% of this $90,000, which will decrease basis. Additionally, QRS partnership incurred loans of $100,000 during the year. So with the partnership, taking on partnership liabilities increases the partner's basis because they'll be responsible for paying the loans if the partnership doesn't pay them. So since Quinn is a 30% partner, then Quinn's basis increases by $30,000. And then at the start of the year, Quinn's basis was $200,000. Therefore, Quinn's ending basis is $140,000.
The weeks leading up to your exam are crucial, and my online course provides you with the necessary tools to take your readiness to the next level. This includes 𝗝cie𝗶ဖိ questions and video explanations. So try out my course to get ready for your exam. So the next entity taxation topic to know about is ordinary business income versus separately stated items. This applies to pass-through entities like an S-corp or a partnership. So when the S-corp, for example, has its income, it's going to pass through to the owners of the S-corp through Form K-1. And certain items do not have any individual taxation limitations, so they're just a part of ordinary business income. And other items do have personal limitations. So for example, consider charitable contributions. You can only donate up to 60% of your AGI in cash contributions. So then when the partnership or S-corp sends you to K-1, they need to separately state the cash contribution. That way it flows through to your Schedule A, and you can see if you actually meet the limitation or not. So if there's any kind of limitation at the individual level, it'll be separately stated. And otherwise, it's going to be a part of ordinary business income.
Now let's consider this practice question on ordinary business income. What is the ordinary business income for the year? Mike owns Tech Genius Solutions, which is an S corporation. So we're going to take each of the items and consider whether they are part of ordinary income or a separately stated item. So revenue is just a part of ordinary business income, so that's included. Labor, no limitations there. Same for lease expense, it's just a part of ordinary business operations, and there are no individual limitations on it, and same for utilities expense. So the only item that is separately stated is the donation to make sure that the individual does not exceed their AGI limitations. So everything else is included to have ordinary income of $220,000.
The next important topic is cash to accrual adjustments. So imagine that a question gives you the cash income, but then you have $15,000 of AR and $10,000 of AP. This means that you had a $15,000 debit to AR and credit to revenue. So it's revenue for the accrual basis, but not for the cash basis. So you'd have to add it to the cash basis to get to the accrual basis. Or imagine the increase of $10,000 of AP. That means that we accrued an expense as the debit to credit the AP, which would decrease the income to get from the cash income to the accrual income. So you want to be familiar with the journal entries involving payables and receivables.
Now let's take a look at this practice question on book to tax differences. How should JKL Corporation report the unallowed 30,000 contributions on its Schedule M1? So Schedule M1 is for reconciling tax income to book income. JKL Corporation, a C corporation, made 100,000 in charitable contributions, but was only allowed to deduct 70,000. The book income before contributions was 800,000. So their book expense is 100,000, but their tax expense is 70,000. This means there's a 30,000 temporary difference. So they need to add back the 30,000 they can't recognize as the expense because you're starting out with book income, and then you need to add back the 30,000 you don't get for the 100,000 minus the 70,000. And then the 800,000 we don't have to do anything with here.
Now we transition into individual taxation to talk about pre-AGI versus post-AGI items. Pre-AGI means it goes into Schedule 1, and that is used to determine your AGI, meaning that you don't have to itemize to take that special deduction. So whether you itemize or take the standard deduction, you still get those pre-AGI items. Post-AGI means it's an itemized deduction. So you want to know all of the Schedule A itemized deductions, what their rules are, and what their limitations are.
Let's consider this practice question for itemized deductions. If the taxpayer's AGI is 100,000 and they chose to itemize deductions, calculate the total amount of their itemized deductions. They made a charitable contribution of 15,000 to a qualified public charity and also paid 5,000 in state income taxes and 6,000 in mortgage interest during the year. So let's consider each item and what the limitation is. So they contribute 15,000 cash, and you can contribute up to 60% of your AGI, so up to 60,000. So they can take the entire 15,000 as an itemized deduction. They pay 5,000 in state income tax, and you can take up to 10,000 in taxes. So they get the full 5,000. And then they have 6,000 in mortgage interest, and there's no limitation on mortgage interest. So the total amount of itemized deductions is 26,000.
So I believe that if you really focus on partnership basis, ordinary business income versus separately stated items, cash to accrual adjustments, and pre-AGI versus post-AGI, you're going to have a huge advantage for taking the REG exam. Thanks so much for watching.